Hi friends, Walt here with the Schultz team. I wanted to talk today about interest rates and how they're really derived. It seems to be this big mysterious thing, and in all reality, when you find out how they're derived, it really isn't so mysterious. We as lenders, we get called all the time, and the common question is, what's your rate? The reality is that anybody that tells you what their rate is over the phone is, one, not telling you the truth, but two, they aren't doing you really a service. The reality is that when we get our rates, so today, I'll have a rate stack anywhere from 2.25% or 2.125% all the way to 6.25%. So what's my rate? It's any one of those. And that's the way it is for all lenders. And so we get that rate stack. The reality is that the strategy behind the rate becomes much more in play than what my rate is. But also how your rate is derived is based upon these things called a loan level price adjustment. Previous to 2008, you could go into a bank, and in the bank, if you had a 680 score and you're putting 20% down, and your friend had an 800 score and they're putting 20% down, they'd get roughly the same rate, if not the exact same rate. Today, that's not the case. There's these 30 loan level pricing adjustments that each client has. So really an interest rate becomes more of a fingerprint than anything, where you literally have a variation of the same rate, but no two people have the exact same rate. And let me explain. So loan amount can affect your interest rate. Loan type, whether it's conventional, FHA, VA, USDA, will affect it. Whether it's a 30-year term, a 15-year term, whether it's a purchase or refinance. If it's a refinance, are you pulling cash out? What's your loan to value? What's your combined loan to value? What property and state are you or what state are you purchasing in? What county are you purchasing in? What type of property are you purchasing? A single family residence, a second home, an investment property, a manufactured home, a condo? Is it 1, 2, or 3, 4 units? What's your credit score, but also what's your credit history? So credit history comes into play. After you purchase your home or after we close on your refinance, how much money do you have left in the bank? Those are known as reserves. How are we doing income verification? How are we doing employment status checks? Are you self-employed? Are you W-2'd? So there's a lot of different factors. Lock period is another factor. Whether it's a 15-day lock, a 30-day, a 45, 60, 90-day, and so on. The longer the lock period, the higher the rate. So what are these factors? And again, that will affect on our rate stack where you come into play at. You can check these loan level price adjustments out at Fannie Mae LLPA. One question that I always ask when clients come in is, I ask them, what would you have to put down to get the best possible interest rate? And inevitably, everybody says 20%. And one thing that you'll find out if you go to Fannie Mae LLPA and if you Google search that and pull up the spreadsheet for it, you'll find that that's actually not the case. You have to put 25% down to get a better rate than you would at 20% down, but somebody putting 15 or 10% down could potentially have the same rate as somebody putting 25% down. But at 20% down, you just took the mortgage insurance away from the investor. And investors have termed that at 20% down, they have a little more risk than they do at 25% down, or certainly 15 or 10% down with that mortgage insurance. So there's ways to be able to look into that strategy, and the answer to be able to get the best possible rate, you have to put 40% down and have an awesome credit score. And that credit score is going to be 740 or higher. So again, check it out. I really just wanted to thank you. If you found value in this video, and I hope you did, please subscribe to our YouTube channel. Also, please reach out to us. We're here to help you in any way that we can. Thanks, and have an awesome day.